Maverick traders, welcome out to your currency midweek update for October 26th. Corey here with you as per usual. As always, just a reminder to make sure that you follow your trading plan. So the FX markets maybe not quite as volatile as some other markets right now, but this kind of comes and goes, of course, and there's always the potential for something big to take place. We're kind of reiterating a lot of what we've been discussing. From week to week, there's not always major changes, but on occasion you get something big that sends ripples through a variety of different markets. And of course, our focus is on trading FX, but we need to look at these other markets. Stocks are in a bear market. They're currently in kind of an ABC corrective wave to the upside. The US dollar has reached an exhaustion level. We've talked about that for a few weeks. It just had this enormous run to the upside. And it's interesting, the dollar's exhaustion high really correlates with bottoming points and reversals in yields, in treasuries, in bonds, in a variety of different markets. And we're going to look at those inverse correlations here in a bit. Inflation is certainly a worldwide concern. The markets keep hoping that central banks are going to pivot, but that's just not going to be the case. Now, if you consider a pivot to be slowing of the advance of rate hikes, backing off a little bit, where you were going to hike by 3/4 and you only, that's what the Bank of Canada did. They were going to raise by 75 basis points. Instead, they raised by 50. I guess you could call that a slowdown in the advance of rate hikes, but it's not a pivot. A pivot would be changing direction. So I think pivot is the wrong word, but I could certainly see central banks slowing the pace. Maybe not being as hawkish, but still hawkish. That sort of slowdown makes sense. The data out this week, not great. We got manufacturing and services PMI data. And a big miss here in the U.S., 46 number versus the 49 expected. And something in the 46s, below 50 shows economic contraction. That's a recessionary type of number. We got numbers out of the UK. We got numbers out of Europe. They were all sub 50 and they all missed expectations pretty much across the board. So not great data this week. Consumer confidence lower than expected. And that's been inversely correlated to energy and gas prices to a certain extent. So let's take a look at markets. Big, nice rally today and so far this week. We touched on this in the weekend trading room on the stock side, that stocks are in an ABC style correction, the 1, 2, 3 wave. And it's just perfect. Again, the inverse correlation. If the US dollar is going down sharply, well, the nice thing about that is rates are coming down and they've been backing up. Bond prices have been rallying, stocks have been rallying. It's basically your risk off assets have been going down. And when risk off, when people are willing to take risk, well, USD and yields and those things have been dropping. Stocks and bonds are beneficiaries of that. And so we're seeing that currently. We're actually seeing that play out in crypto and some of those markets. So look at crypto up 7%. Gold and oil, everything pretty much up across the board that way. As you take a closer look at this rally here, it really makes sense if you follow kind of Elliott wave theory and different things, where you're seeing sort of an ABC style correction. The first wave up, everybody kind of doubts it, and then you get a little pullback and it actually is bought and creates a higher low, and then you get another spike and another surge. Now, does that reverse everything? No, it's a correction, right? It's a corrective wave within an overall dominant bear market. And so things don't just go in straight lines, they're zigzags, right? And you could have even looked at this as kind of a 5-wave pattern of sorts in the way that we went down, right? We dropped, we bounced, we dropped, we bounced, and then we dropped again and made a lower low. And now we're just kind of correcting off of that. So that C pattern stalls out somewhere up in here in all likelihood. and then we probably resume the downward trend. Is that coming? Is that what's most likely? I think there's a very good possibility that that's kind of the path that we're on. So as we look at price action, one thing you could do is actually drag Fibonacci lines. You could say, well, here's the peak and here's the trough. Where would be your levels? Well, a 50% retracement still has a little more room to go. So if you were to recover and bounce back half of the decline, if you were to recover half of this drop, it would bring you up a little bit further. And if you were able to get to, 61.8% retracement, obviously even a bit further from there. But I don't think that this is the major bottom that everyone's going to hope for. Could you rally for a few weeks and kind of stay choppy and have a little window here, maybe even into the end of the year where markets are decent and good and kind of stable? Yeah, I wouldn't doubt that as a possibility. The probability that we're done, though, ultimately with the bear market, probably not there. We just made lower lows, right? So what comes next is probably a building of sorts. And if you are going to, if this is the bottom, you're going to have to carve out kind of a sideways pattern here for multiple months. And then we would reassess at that point and say, hey, the markets are not falling anymore. They've created this big base that it could kind of break out in either direction, and then you'd get a big upside breakout at some point in 2023. My guess is that this bear market still has control big picture. But right now on the trading side, you do want to play corrections because it's a good size correction. So you don't just, ignore it entirely. As we look at currencies, again, kind of the things that were going up because people were nervous are having a rough week this week, specifically the US dollar. The dollar's coming off, and once the dollar started to kind of come off more aggressively, the heavily shorted things like euro and pound bounce back. But again, it's really related to the bond market and to yields. When you think about what a huge market FX is, bonds are much, much larger than stocks. And so from the standpoint of which one's more important, it's more the bond market. And the bond market, the last couple of days, has really bounced back. Yields have come down sharply. I think there's a really good chance that bonds have set their low, that bonds have actually bottomed. They might not go up a lot, but I don't think they're going much lower. I'm kind of the mindset that yields have probably hit their high. That's the opposite of that, right? The yields are probably stalled out here at about 7.5% for a 30-year mortgage. I don't think there's going to be much demand for mortgages above 7.5. I think that yields have kind of hit their high. I'm not so sure that stocks have hit their bottom, but I think bonds have. I think yields have hit their high. Well, the inverse of that is really, I think that the US dollar has hit its high. I'm not sure that the US dollar goes much higher for an extended period of time. I'm not one to say like, oh, I called the top or I called the major bottom, but if you think that the US dollar is heavily correlated to yields, which I do, and I feel pretty confident that yields have kind of reached a significant high, which I do, then the correlation there is basically the US dollar has probably hit its high. I'm not trying to, predict the high. That's the way I see it. That's kind of the pattern I think that we're in. So let's come over and look at some other aspects to this market here. Let's look at what we've got going on for the rest of the week. So we're above the 20. We're kind of bouncing around the 50 right now. For this week, we actually gave it a positive outlook on stocks actually coming into this week. We thought the market would rally a bit through this week, at least the first part, and we have. Well, let's look at some of these markets here. So international stocks look similar to US-based stocks, kind of that ABC style correction, right? Probable that we kind of stall out somewhere in here and then start to test some lower levels. If we look at crypto, I have to give crypto credit. We talked about how this has just been dead. It's been unexciting. It's not doing much of anything. Well, it's finally showing some signs of life. Now, the directional move is debatable. You're perhaps at the top end of this big descending triangle. Do we break out from here and go up, up, and away? Is this kind of a false, like kind of fake out move up to the top of the range and then it plummets back down? You know, again, I think this is somewhat correlated to yields, but people are probably getting a little too excited. The idea that you want to come running into crypto because yields are backing up from 7% yields down to 6%, well, that's still just, that's such a different game. When you think about 6% yields, being in a cryptocurrency is very speculative. It is a non-income producing asset. It really doesn't have any fundamentals per se because there's no revenues, there's no earnings, there's no cash flow, there's no nothing, right? It's just a coin and it's based on supply and demand. It's kind of, hey, if people are willing to buy it, it goes up. If they're not, it goes down type of thing. And it's just a competitor, I guess, in currency land. But there's no real fundamentals. Now, someone might say, well, governments don't have fundamentals. Not true. They get cash flow. They tax citizens. They do a lot of different things that way. So it's different than company fundamentals. It's government fundamentals, but at least they have a source of income per se. The U.S. government can tax its citizens, and that's income coming in, and then they have expenses, and you can actually do some fundamental analysis. So I think it's short-sighted to get too excited about crypto because yields are coming down. Because yields at 6%, a large institution, a huge bank that says, man, I can go to the fixed income, the bond market, and safely get 6, 7% for my customers. Do I want the hassle, the headache, and the volatility of crypto? And I think the answer, unless you're an ardent believer that this is the future, those that are just kind of in the middle ground, now there's true competition. It was an easier sell when yields were at 0%, right? Because you couldn't make any money anywhere in bonds when government yields are at 6% or 0%, pardon me, or even negative. Now there's some actual competition, and that spells trouble for things that lack solid fundamentals. And crypto, you can kind of tell by my tone, I'm not necessarily one of those that believes that it's the thing that's going to carry us into the future and it's going to solve all our problems and Bitcoin's going to trade in the millions. Some people believe that, and those believers should be buying here, obviously. I see it as a tradable asset. I see it as something that we can trade during periods of time, and I'm concerned that crypto may not have what it takes to break out from here. And I actually think the risk to reward, look, this is the beauty of the midweek. I always get graded on my expectations, right? Because I'm either a hero or a zero based on this trading call. But my trading call would say this is a pretty good risk to reward right here, right now, to look at some crypto shorts. And if you're wrong, you stop out up here, and it's a little painful. Stopping out's never fun, and losing money's always a little painful, but that's the game we play. But if it's right, not only do we trade to the bottom end of the range, I suspect we trade below the bottom end of the range. So is it bouncing because the dollar's coming off and because yields are coming down and so on? Yes, but I'm not so sure I trust it to make the significant move. And I could be dead wrong about that, but I'd be much more inclined to short that at the top end of that downward descending triangle pattern. The rest of this week, we've got advanced GDP coming out tomorrow. So we obviously had negative GDP last quarter. The expectation is for positive GDP this quarter, and the initial expectation is at 2.3%. Are we headed towards an economic recession? Yeah, I think all the signs kind of point towards that, but it's going to be a recession. I mentioned this a few weeks ago, and I'll just reiterate it. I'm not so sure that this is one of those severe, deep recessions where it's like there's a crisis and things are collapsing. Most recessions in history are not big, violent, deep, catastrophes. A recession is a slowdown. It's a period where the economy doesn't grow, and it's not like everything's falling apart and all hell is breaking loose. That's not what most recessions are, and that's kind of where I think this one's going. It's going to be a long, drawn-out process where we pay the price for some of our stupidity in terms of risk-taking that people were taking, the lack of, just basic good decision making, the lack of foresight on the part of the Fed to see that inflation was going to be an extended problem. And the Fed's going to fuel that because they're going to continue pumping the brakes and basically saying we got to get inflation down. And the problem for them is that inflation's slow. It's slow to move because a lot of it's based on rental prices for homes and all these sorts of things that are just slow to turn. So it's going to be a drawn out, I think, lengthy process that's going to have a lot of frustration and probably ultimately end up with lower stock prices from here. And I actually think bond market stabilizes, bonds stop going down. Bonds are probably a good buy here, frankly. Yields back up and the US dollar backs up, and we're just kind of drawn in this process for the coming months. That's the way I see it. GDP comes out for Canada on Friday. We are going to trade the ECB meeting on Thursday. That is on the calendar, so we'll talk more about the calendar here in a bit. But the ECB meeting comes out on Thursday morning, and expectations are that they're going to raise rates. They're going to go up by 75 basis points is what the market's anticipating. Let's go take a look at a few things, and I'm going to start with some correlation charts. So let's come in here. And again, this is kind of a daily chart here of Bitcoin and Bitcoin Cash, Ethereum. It's our basket, right? And as I look at this, again, I kind of look at it as a descending triangle. This is what I would expect we're looking at here. So you can just, it's, in some ways, the trend lines draw themselves, right? That line just perfectly goes across those peaks and is right where we're at. And this line down here, it basically just draws itself. This is your support level, and sure enough, the same general area that bounced, that's where we kind of bounce there. And so somebody's going to win. Somebody's going to win and somebody's going to lose. It wouldn't shock me if this made a little false move here and then kind of collapse back down. Remember the saying, from false moves come fast moves. But I'm making a trading call here, and I think you get short crypto for that next leg lower. I don't trust it. Now, some might say, well, it's breaking through some moving averages. I think you've disregarded the moving averages for the past few months. Moving averages are just not helpful in sideways consolidative patterns, and that's what we've been in. Just don't even pay attention to them. They're on your chart. Who cares? Did it matter that we went above the 50 back here? No. Did it matter we went below it back here? No. Above? No. You just ignore them when you're in a consolidation. So make no mistake, we're still in that range. Don't get too excited about this. This is sort of kind of a bad thing in that it's trying to surge, but it's still within its bearish trading range. That's not ideal. You'd almost like to see it breaking here with big volume. That could happen, certainly possible. I don't see it as likely. Here's what I was talking about in terms of the bond market. So I'm not a big Twitter guy, but I actually did tweet about bonds over the weekend. advocating that I think yields have peaked and I think bonds are finally a buy. And so far, I mean, this is a big move in bonds. It doesn't look like much, but we're talking about it's up as much as the stock market. Bonds are slow to move. Bonds should have volatility that's like a fourth of stocks or whatever. And so for it to bounce as much as stocks is kind of telling. This chart looks like absolute death, no question, but you kind of look at it and you put these things in context, right? We talk about, you know, here's emerging market debt, here's US Treasuries, and you look at all of them, they all have the same pattern. But one of the things that we teach is this process of analysis where you kind of look at the long-term trends of things and you look at the four stages that a trend goes through. And if you put it into four stages, let me pull up this other charting platform and just think about it in the four stages. What are the four stages? Well, I've taught classes on this, but basically you go through a long extended period of consolidation. That's stage one. This is before the marathon has begun. Well rested, get a nice meal, have plenty of energy stored up because you're about to run a race. When the race begins, you basically start to break out of whatever that consolidation was. And in this case, it's to the downside. And of course, volume tends to ramp. And volume is, I always compare volume to adrenaline, to energy, right? Adrenaline. I'm not sure I spelled that correctly, but I'm trying to talk and write at the same time. But adrenaline spikes. Well, if you think about running a marathon, there's two areas where your adrenaline will surge. One is at the starting gate, right? When the race has just begun, and you'll see them kind of sprint out of the starting line, right? Those runners. Now, I'm not about to go run a marathon, but I use this analogy because that's where your energy will surge. In the middle of the race, we call that stage two. That's your breakout phase. Stage three is the continuation. In this case, you're in a downtrend. You just continue to go down. You have your little corrections, you have your bounces, but you just continue to sell off. But importantly, when you see the finish line, let's call it that, when you see the finish line out in the distance, once again, adrenaline or energy starts to surge. Why? Well, for one, the pain's about to come to an end, right? You're finally going to finish this race, but you're going to sprint for the finish line. Assets will sprint. See how this thing turned, absolutely just straight down at the tail end of this move. That is a sprint for the finish, and we call this the exhaustion, where basically it's capitulation is what they call it in the markets, which is just giving up, throwing in the towel. That's what that means. It's just you finally throw your hands up in the air and say, enough pain, I can't take it anymore. And that's what happened in the bond markets. Just last week was kind of the final phase of that pain, where people just said, I can't take this pain anymore. And a lot of it's forced liquidations. People have leveraged up on bonds thinking that bonds could never have this type of volatility that they've had in 2022. And you just never say never. I don't care if something has never happened before. Anything's possible in the financial markets. And, I love the analogy that Rob uses. Rob uses this analogy that the market's like a lion and we're the lion tamer, right? And it's going to do some unexpected things. It doesn't matter if that lion's never done this before. It has the possibility of doing any and everything, and it's dangerous. Now, as the lion tamer, we can stand outside and we can decide when we want to go in there, right? And it would be logical to go in when it's safer, when there's things that we recognize, behaviors that are good, right? And if it's behaviors that are unrecognizable or it's hungry or whatnot, right? We could feed it the lion and then go in and we're safer because it's well fed. If it's really hungry and ornery and, we'd probably stay out of the cage. So that's kind of how you think about the markets. And stage 4 is just it. Look, these patterns are recognizable. We're recognizing what's happening here, and we're recognizing that there's mass amounts of pain, that people have just thrown in the towel, whether it's forced liquidations, whether they want it to happen. It's kind of that end phase. Now, we've been bouncing back sharply, which probably happened first. That's that first little phase, but then it probably goes choppy here. This is what normally happens in a stage 4 is you kind of bounce back from the final, that last spike down. You recover it back pretty quick. That's what they call the V-shaped bottom. But then you do this, and then there should be another breakout that goes higher. Okay, that's how bonds should look here in the future. Is we initially bounce back quick on the final phase of that, consolidate, and then we get a further rally out in the future. This bond market chart is the exact opposite chart of yields. If you were to look at yields, it's everything that looks like this in reverse. Yields were sideways, then they broke out, then they continued, and then they skyrocketed right in this last little phase. And that's where mortgages went to 7.5% and so on for a 30-year, and where we were kind of at. And now we're going to get that initial spike down in yields, then consolidate, and then yields should back up even further. That is most definitely how I think it plays out. Well, how does that correlate with the US dollar? US dollar's been moving with yields, and I think the top is in for the dollar for a while. So again, it kind of went parabolic here. The initial phase down, consolidate, now down lower. I think the dollar just drifts, a lot of choppy behavior, but drifts lower over the next couple of months. I think the top is in for the dollar for the foreseeable future. So, those are kind of my takes, my opinion, the way I see it. You might disagree on some, you might disagree on all. I don't know, but that's kind of how I would anticipate things to work. So I'm in, if we look at the US dollar chart, what am I in? Well, I'm basically in sell the rally mode for the USD. When we see rallies in the US dollar, I want to sell it. That doesn't mean I sell it short here immediately, but I do want to sell it. I think, do we get bounces? Sure, right? And when it bounces, I would expect it to make a lower high. You could see a little head and shoulders top is what that pattern's called. But should it establish a lower high in the coming days on any bounce? Absolutely. So I have turned into a sell the rallies in USD. Get short US dollars against other currencies. We did talk about this a little bit in Euro USD. Let's pull that chart because we spent a little time on that. Let's see if we've got it here. So let me take away some of those drawings, but basically kind of talked about this process here in terms of the euro. The anticipation was that we're starting to frankly bottom out, that you want to buy the dips in Euro USD, that it should work its way higher here. And looks pretty good from where I'm sitting. That kind of downtrend line, that 50-period moving average, that the trend has reversed. You can even see kind of a symmetrical triangle down there, and we've broken out to the upside. Notice where we're back to. We're back to 1. We're back to parity in Euro USD. Now, you've got the ECB meeting tomorrow. Could this thing pull back? Can the dollar rally? Yeah, that's where we want to trade it. I always emphasize, look, I don't love buying breakouts against downtrends. So you have all this overhead supply, right? I'm not a big, if we're playing something that's reversing from a long-term trend, I'd much rather play buy the dip than buy the rip. So I would be less inclined to buy up here and more inclined to buy on the pullback and then play the next wave. That's how I would see it. But again, that's kind of my outlook there in Euro USD. If you come into shorter time frame charts, you can see some of these patterns and things that we've talked about. Here's the 4-hour chart of Euro USD, and little kind of cup and handles and whatnot that continue to work to the upside. So I think that's a good place to keep hunting for the coming weeks. Basically, the long-term trend is basically bottomed out here, and although it'll be choppy, it should continue to work its way a bit higher. Can you work your way in Euro USD up towards 104 or something like that by the year end? Yeah, I think that's a very real possibility that we get back up there towards where this thing started to break down back here. That type of upside target, big picture, long term, makes sense. 10s and 30s have uninverted as well. So, yeah, we've had this inverted yield curve for a long time, right? Where we talked about that. That's a great recession predictor, basically. And the 2s and 10s are still inverted, or at least last look they were. But the 10s and 30s have started to to get back towards normal pricing, where the 30-year yields more than the 10-year and not vice versa and such. Again, I think that's part of rates getting back more towards normalcy, and some of the, let's call it a crisis in bonds. You haven't seen it as much in other markets as you have in bonds. The amount of volatility there was pretty astounding. So kind of ugly price action, but has bottomed out importantly. So good stuff. All right, we have a busy schedule. The rest of this week, we've got ECB rate statement recording comes out today. We're in the midweek now. Preview of the Bank of Japan, which also has their meeting coming out this week. In fact, the preview comes out Thursday because the meeting is Thursday night. The ECB press conference we talked about, we're going to be trading that live on Thursday morning at 8:15 a.m. Eastern time. So if you're on Eastern time, 8:15, 6:15 Mountain. And then we also have a separate video of basic order entry and bracket orders. So plenty to keep you busy this week. Bank of Japan meeting, ECB meeting. I like selling the US dollar on rallies. I like crypto short right here, right now, sooner rather than later, type of thing. I'm making some trading calls here, and we'll grade. As always, the market grades your work with profits or losses, right? But of course, I got to come back and on occasion be in these midweeks and say, I had this one wrong, but hopefully we can get most of them right. Have a great rest of your week, and we will see you next week. Same time, same place. Goodbye, everyone.